So the first part we're going to do is actually define what professional traders do. Question one, what does a guy in an investment bank do, a professional trader? What does a guy at a hedge fund do? They're quite different functions, quite different roles. What does it mean for the retail trader who's trying to emulate them? And the differences between professional traders and retail traders. So professional traders at investment banks, 90% of a trader's time at an investment bank is actually spent being a market maker. And only 10% of their time is actually spent trading the bank's money and using that money in an attempt to make a profit. So when you look on CNBC, Bloomberg, on the television, and you see the trading floors with all the guys walking around and lots of screens at their desks, what are they actually doing? Well, 90% of the time, they're just making prices in the market to clients. So is that what we do as retail traders? Who says yes? But it's clearly not. We don't have any clients. We don't care. The objective here, like this gentleman already outlined, is to just make money. Using our own money to make money. We've got no interest in market making. But let's have a look at the business, how it actually works. The market making business is literally the bread and butter of the bank. And it's split into two categories, really. It's an agency business and a risk business, okay? What do we mean by an agency business? You're not on risk to the client. So the agency business, literally, a guy calls in from a pension fund or a hedge fund and they want to buy an asset. They give the bank the order to buy the asset on their behalf. And it's just executed in the market. And a commission is charged. And commissions are charged in basis points. And 100 basis points is 1%. So what's a typical commission these days? Anybody? What do you think? On an agency trade. Who said 5 basis points? Yeah, 4 or 5 basis points. Around a decade ago, the industry standard was about 20, 25 for agency business. So all things being constant in terms of volume in the markets, the agency business is down 80% in the last decade. That's one of the reasons why banks struggle. And this is totally risk-free stuff to the bank. The phone just rings, a salesperson takes the order, puts it in the system, and it goes through typically into an algorithm, and the algorithm executes it electronically. So there's very little human intervention. And that's pretty much 80% of all market-making business. So what does that tell you in terms of the time split of a trader at an investment bank? What does it tell you? What was the number in terms of time? They were spending 90% market making, yeah? And 80% of it's agency. So the vast majority of the time, they're actually just sitting at computers watching orders being executed in the market and just supervising them. That's the vast majority of what professional traders at investment banks do. It's pretty boring. But the perception is that it's totally the opposite. People think that trading floors are these huge hives of activity with lots of noise and everyone's shouting at each other. It's just completely the opposite now. Like you can walk onto the Goldman Sachs, Morgan Stanley, Bank of America, Merrill Lynch trading floor, and it's quieter than this room. That's what they're doing most of the time. So 2 things. Firstly, get it out your head that a trader's job is exciting. It's not. It's literally the opposite. It's really, really boring. And secondly, if you're a retail trader, the vast majority of what guys at investment banks do, if you're trying to emulate them, you're not emulating what they do the vast majority of the time. Because your objective is to make money using your own money, not execute client orders through an algorithm. But 20% of the market making business is on risk. So instead of a client calling into the office, pension fund, hedge fund, and giving a risk-free order to the trader, which they just bung in an algorithm, the phone rings and a salesperson picks it up and the client asks for a price in the asset, and the market maker goes on risk to the client. What does that mean? They take the other side. So an example here, buying $10 million of Apple stock at $500. So 20,000 shares. What actually happens, the trader is short on the other side. So they're short $10 million of Apple stock at 500. If they buy it back above 500, they lose. So what does that actually mean? Well, it means the trading function in the risk model is to be the gatekeeper of the bank's balance sheet. So the trader uses the bank's balance sheet to attract business into the company. Now, if they're trading, they're not trading one stock at a time. Typically, a professional trader in an investment bank will be trading between 50 and 100 stocks at any one time. And what that is known as in the industry is a negative selection portfolio. You end up with 50 to 100 positions in stocks or the assets that you trade, which you don't even want. The reason why you're doing it is to bring business into the firm. So you get so the bank gets the commission. And where do those commissions get tagged? They get tagged on the sales desk. So the traders on the trading desk offer the bank's balance sheet to the world as liquidity. And then pension funds and hedge funds come in and use that balance sheet to trade. And then they get rewarded by doing big trades on risk, by getting nice, juicy, free agency orders to say thank you next week. Thank you for the week before, for going on risk to me in a situation where you knew you were probably going to lose money. And the ability of the market maker is really priced on their ability to keep the commission. And we call that a loss ratio or a retention ratio. So if $100 million comes in 1 year, and you manage to keep $80 million of it, which is a bloody good performance, your retention ratio is 80%, which means you're a shit hot market maker.